Today's episode is brought to you by Mazars.
SoundCartel.
From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. All eyes were on Victoria this week with its delivery of the state's annual budget and how it's going to rein in its ever-increasing debt. There's also the potential that other states around the country will adopt Victoria's revenue-raising initiatives. One tabled for legislation is the Commercial and Industrial Property Tax, or CIPT, which is a major change for the Victorian property and investment sectors. Stephen Baxter, National Indirect Tax Partner at Mazars, offers Chris Ashmore some context to the proposed tax.
Victoria, like New South Wales, Queensland and the Commonwealth, in fact, has a massive debt, COVID debt, infrastructure debt, etc. Our governments need more revenue. The Victorian government sees the commercial and industrial property tax as a long-term project to raise its revenue base on a more efficient means than the transfer duty. What has also been true in recent years is that the Victorian government has been the most active Australian government in raising taxes, and what Victoria has been doing at state level, other states have often been copying, like the foreign person residential land surcharge.
Well, it's a very clear and specific name, isn't it? The Commercial and Industrial Property Tax. Does that mean if I own a commercial or industrial property, I'll have to pay tax on it?
Well, the first thing to mention is that the bill to impose the tax is still making its way through Victorian Parliament, but assuming it does become law, the answer to your question is no, surprisingly. If you currently own a commercial or industrial property, almost certainly you will not have to pay the commercial and industrial property tax on it. We might just call that CIPT from now on. But rather, if you acquire a commercial or industrial property from 1 July 2024, this year, you will eventually have to pay CIPT on it.
Does the bill state when that will be?
Yes, and it's via a two-stage process. Firstly, transfer duty, or stamp duty as many people still call it, that'll apply when you purchase that property on or after 1 July 2024. The clock starts ticking and the CIPT will only apply after 10 years from then. Assessments will issue in the January to March period for commercial or industrial property owned at the previous 31st of December. That's just like how land tax works.
Mm. Does that mean then I'll be paying two types of tax on the property I purchase?
Yes, and you can say it's even worse than that. For example, if you settle on a purchase of a retail shop in, say, September 2024, you will pay duty on its purchase. You are likely to still have to pay land tax and council rates on it. And if you still own that property at January 2035, you will have to pay CIPT on it.
If I were to sell that property, will the next buyer have to pay transfer duty on it?
No, not for the duty. Your purchase will be the last time duty is ever paid on it. The 10-year transition period will follow after your purchase, and then the CIPT will apply no matter who owns it. It should be noted that the 10-year transition follows the first purchase from 1 July 2024 and not from 1 July 2024 itself. So if today's owner of an office block sells that to you in, say, 2027, you will have to pay duty on it then and then pay CIPT from January 2038. So you can see from this that until a property is entered into the scheme, CIPT won't apply to it, and it might not apply for 50 years in these cases.
And what's the rate of that proposed tax?
The CIPT will apply at the rate of 1% on the site value for most types of commercial or industrial property. That's the same unimproved land value that land tax is paid on. And it's going to add up. That amounts to $10,000 a year for a $1 million land value.
Any exemptions, any exclusions?
Well, by definition, the residential land and farmland will not be subject to the tax, but certain land transfers currently exempt from duty will be exempt from CIPT. For example, where a super fund makes an in-specie transfer of its property to a beneficiary. A main exclusion and a planning point relates to purchases of part interests in property. If your total acquisition is of less than a 50% interest in the property, it will not trigger CIPT.
Any complexities?
Yeah, there's a long list of these. Among others, certain build-to-rent residential developments can be subject to the tax, but that's at a lower rate of 0.5%. Another complexity is the tax can apply to land subject to consolidations or subdivisions. It can also apply to landholder transactions, and these are acquisitions of shares or units in a land-rich company or trust. Creeping acquisitions of part interests may trigger the tax, and changes of use of property from, say, residential to commercial or vice versa, they may also trigger taxes. The rules in these areas are quite complex.
When it comes to investment decisions, how will they be affected by CIPT?
Well, the CIPT will not apply to commercial or industrial property purchase contracts made prior to 1 July 2024. So, for example, if you execute a contract in June 2024 to acquire a factory, you will pay duty, but you'll never pay CIPT on it. Now, that chance to escape the tax is causing a lot of prospective buyers to consider whether they should bring forward their acquisition. Buyers of commercial or industrial property with a price of less than $30 million may wish to consider a transition loan, allowing them to spread their upfront duty over the 10-year transition period. This is a new concession, and it's not available for residential home buyers. A critical issue is whether a commercial or industrial property landlord will be able to recover the CIPT from a tenant as higher rent or higher outgoings. In determining that, it's important to remember that from 2035, commercial or industrial property will fall into three categories. Some properties will be subject to the CIPT, some will be still in their 10-year transition phase and not subject to CIPT yet, and others will still be in today's ownership and not subject to CIPT at all. In those earlier years, there must be grave doubts whether the market will enable landlords to recover CIPT from tenants, as so many comparable properties will not be subject to the tax yet. Already the market is asking whether the CIPT will affect commercial or industrial property values. This is a hard matter to determine, as the CIPT, of course, does not apply until at least 2035. And even then, the properties will fall into those three categories we've just mentioned. However, you'd have to think that the appearance of the new tax must place some downward pressure on property values. This, of course, leads to the final question. Is commercial or industrial property still a good investment? There's not a simple yes or no answer to that question, but it's certainly one everyone's already asking.
Absolutely. Well, there's a lot to think about there, Steve, and if listeners perhaps have any questions about the tax, what should they do?
Well, I'd encourage listeners to call their usual Mazars partner, or they can call me on 02 9922 1166.
That was Stephen Baxter, National Indirect Tax Partner at Mazars. Business Essentials Daily is a SoundCartel podcast. Producers are Nick Schildberger, Chris Ashmore, Jeff Waters and myself. Technical production by Pete Letts. I'm Nicole Goodman. Thanks for listening. We'll bring you more B Daily next week. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.